Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the power of technical analysis, using the StockCharts platform to better quantify investor behavior, better understand investor psychology, and appreciate the lessons of market history. We have been in an interesting year in 2022 with a lot of interesting moments and a lot of bear market rallies. This rally from June, July to August, at the very least, is very different than the previous rallies as we've seen so far. And you can measure that by a number of different things. The fact that we've made it above the June swing high in a lot of cases, very, very different. Previous rallies, we haven't been able to do that. The fact that the momentum has gone from so negative to so much more positive is unusual. That's not the strength that we've seen, particularly in the previous bear market rallies. We're going to look at the evidence, as always, and see what we learned today relative to the big picture, and some really good conversation as we do so. A couple of quick announcements before we continue on. First off, our upcoming guests. I'm excited to talk to Craig Johnson here from Piper Sandler in a short while. Tomorrow, on Wednesday the 24th, we have David Auerbach from the Daily REIT Beat. On Thursday the 25th, Tony Dwyer from Dwyer Strategy and Canaccord Genuity in New York. Then coming up next week on the 30th, Joe Rabel, who hosts Stock Talk with Joe Rabel here on StockCharts TV, does a fantastic job as a stock picker using purely technical inputs in his work. We'll get his take on this market as well. Also wanted to let you know about ChartCon. If you go to stockcharts.com/ChartCon, you will find all the information about our upcoming event. This is a virtual conference we will be giving on October 7th and 8th. I would encourage you to sign up today. It's going to be a fantastic two-day event. Today, I wanted to highlight some of the panel discussions. We'll be doing a lightning round, a stock picking lightning round with Jay Woods, Ms. Schneider, Mary Ellen McGonigal, all providing 5 stock and or ETF ideas. We have a bull and bear market risk panel. We'll talk about how to manage risk in uncertain times. And then we have an interactive market outlook panel. We actually ask all of you attendees what you think about certain markets between now and year end. We will review the results together as a group and then discuss and debate. Getting a group of people of this caliber together to have conversations is a rare treat. And I hope you'll join us at stockcharts.com/ChartCon to enjoy that event. Let's continue on today's show with our market recap. We'll focus on what the market did today. Choppy day. I wanted to start first with a poll because we're at a really interesting time seasonally for the markets. We asked you recently on our live stream page at stockcharts.com, also on social media. So make sure you follow us on Twitter, subscribe to our YouTube channel. You won't miss a poll. We asked you how important are seasonal trends in your process. They're a primary input, not as important as other things, but I use them regularly. I use them occasionally, but not very often. Or what are seasonal trends? I don't even care. Most of you, about 52% of you, said I use them occasionally, but not very often. I respect that. It's not the top of the list for me, among other things. I would much rather focus on the message the market provides in the form of price and breadth, the information we can get from sentiment. But I would say cyclicality and seasonality is probably in there with sentiment in terms of interesting ways to understand what's happening. And a lot of what we do as market strategists, as investors, is try to understand what the market is telling us and try to position ourselves based on what may come next. Might be one of those times, if you use it occasionally, it might be a really good time to look at seasonality. And we're going to start there actually today. What you can do on stock charts, looking at the charts here, is if you click on the top of our site where it says Sharp Chart and switch to seasonality, and then you can type in any ticker. We're going to start with the SPY. And we're looking at the last 5 years to start. I'm going to bring in a little more data here going back for the last 20 years. So starting in 2003 to where we're at today, I'm getting 2 pieces of information from this. The batting average, what percent of the time does the S&P finish that month higher than where it started? And then the numbers at the bottom of each histogram telling you for each calendar month, what's the average return? So literally the mean return out of the number of observations that we have. Right now, we were in July. Now we're in August. You can see in general, tends to be pretty good hit rate over the last 20 years for how well the market has done. So not surprising, I guess, from a seasonal perspective to see how the markets have rallied pretty nicely off of the low in June. June, by the way, pretty weak month, relatively speaking, one of the worst performing months in terms of the hit rate, and also one of the lowest, the second lowest average return for the month. But now we're getting into September and October. And if you look, September, again, while positive 63% of the time, you have to remember there are a lot of bull market years in that history. which certainly would provide a lot of months were positive during some of those years. But relative to the other months, one of the weaker hit rates and certainly one of the weaker returns. It's actually third from the bottom in terms of the average return in September. What concerns me about the S&P when we're looking at where we're at, when we're looking at how the markets have rallied so beautifully in June, out of June into July and now into August, is we're entering a relatively weak part of the calendar year. I would look forward, though, to say that the end of the year tends to be pretty decent for stocks. And if you look at growth stocks, you'll find a very similar reaction here. Most of the time, November and December actually tend to be pretty good. And most of the time, the average returns or looking at the average returns, they're pretty decent as well. So we are entering a seasonally weak part of the year and then finishing up with a seasonally strong part of the year. That could give us a potential playbook about what to expect looking forward on the S&P and the major averages. However, the evidence has to be reflected in price, right? Ralph Acampora, one of my mentors, and I know Craig Johnson, who we're bringing on, one of his mentors as well, always told me that price is truth, right? If you know nothing else, look at the price of the S&P. That will tell you a lot of what you need to know about the market dynamics. So what I have to do is observe a number of things. Number one, we've accelerated off of the June lows, and just looking visually at this rally that we've seen in the last 8 weeks versus previous rallies in 2022, this has certainly been stronger in terms of momentum, in terms of the duration of the rally, and also just the magnitude, right? It's gone much higher than in previous bull market rallies. So we are bouncing off of the 200-day moving average, pulling back. We're nearing 4,100, and that's an interesting price point. One of my guests last week, and I forget who it was, maybe Jeff Hughes, I want to say, but I don't really remember in particular. But one of our guests talked about that 4,100 level. And so I perked up when I was looking at the market over the last 2 days, seeing how quickly we were approaching that level. Any of these levels which served as resistance can often serve as support. So I'm immediately looking at some of these lines we were talking about previously to see if we're able to find support there. Again, not surprising to get a pullback off of the 200-day moving average and overbought conditions, a lot of individual names pulling back from their 200-day as well. What I wanted to do at this point, because the question is what's next, let's bring up a poll. I actually did a webcast earlier today all about seasonality, which is why we started there today, kind of fresh in my mind. We talked about a lot of the lessons, and I asked the attendees of that webcast, is the next 10% on the S&P 500 going to be higher or lower? 10% higher would put us near the February and March highs. 10% lower would put us near the May low, basically, right? Right around, you'll call it 38 and change. Basically, only 23% of the respondents said higher. 77% of the respondents said lower, which would put the S&P around 3710, which would actually almost test the June low. So given the choice, do we retest the April-March high, basically, or retest the low in June? 3 out of 4 of the people that we interviewed or that participated in the survey earlier today suggested the negative outcome. That tells me a lot about where investors are at, given this pullback. I would love to have done that poll a week ago and see what the results were there versus what they were now. Because obviously we've seen some short-term pain. There could be some recency effect, right? Where we see the short-term pain and feel like there could be a little more. But I'm skeptical given the seasonal weaknesses, given the fact that we've pulled back. The end of the day, the market will tell us what the market can, and that's in the form of price. Let's keep a good attention on what the evidence tells us. Let's look at the evidence today. Choppy day, as I mentioned, the S&P down about 0.2%. The Nasdaq actually chopped around quite a bit, but finished flat from yesterday's trading. The VIX pushing a little bit higher now, well above 20, up to 24. Other markets very quickly. Interest rates pushing a bit higher. 10-year yields getting above 3%, which is noteworthy, finishing the day around 305. Long bond yields around 325. Commodities, broadly speaking, pushed higher, and energy was the strongest performing sector, and it wasn't even close. We'll look at the sectors here in a few moments. And then mixed results overall from cryptocurrencies today, with Bitcoin and Ether both in the green, but some of the 10 most liquid coins that we track here actually in the red. Looking at sectors here very briefly on the right side of my screen, energy up 3.6%, followed by materials up about 1%. Then everything else was sort of a little bit up to a lot down, and real estate and healthcare both down over 1.4% today. What's interesting about this is energy is up 3.6%. The markets are essentially down a bit. This can happen. This is basically what tends to happen when energy is leading. It's unfortunately such a small cap weight in the major averages. So even if energy is working in a big way on a particular day, the averages won't usually reflect that if the other stuff is down. And when technology, communication services, some of the larger sectors, consumer discretionary, are flat to negative, the benchmarks are most likely going to follow those sectors as opposed to strength in energy and materials. It's a good reminder there to focus on what's working. And for today, and really in the last week or two, certainly seen some renewed strength in energy and in materials. Let's take a quick commercial break. We'll be back with today's guest, Craig Johnson. We'll see you in a minute. Every trading day to help you make sense of these markets. Some of our shows like Sector Spotlight with Julius DeKempener, Stock Talk with Joe Rabel every week. Tom Boley does a show twice a week. He's done a great job of navigating these markets in the last couple months. All of that content and so much more available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Craig Johnson. Craig's the technical analyst at Piper Sandler, joining us from Minneapolis, a frequent guest on the show. And Craig, we are good to, it's a pleasure to see you. And we're excited to get your take on what's happening right now. How are you?
I'm doing well, Dave. And thanks again for having me back on the show. Let's first start out talking about the S&P 500, because everybody wants to know the direction of where this market is going. And there's one of the things that I have been having lots of conversations with people about is, oh, Craig, we've gotten right up to the 200-day moving average right there on the S&P 500. You would also say that's right to the downtrend resistance line off the highs we had seen in January of the year. Now, there's one big differentiating thing that people are not thinking about right now, in that in the entire downturn, we had seen a deterioration of market breadth. The breadth of the market was, and what I will define that, Dave, as looking at how many stocks are above a 200-day moving average simplistically, and all of the stock chart users can certainly pull that up and look at it. But the breadth of the market actually truly started deteriorating in February of 2021. It's been about 18 and change months that we've been actually seeing the breadth of the market deteriorating. And because of that, that's where I come back and I just look at this market and I say, there's a big reversal that's happening here in breadth, not only with the 200-day, but also with the 50-day moving average. And what is different about this move compared to what you'd seen back in the March and April timeframe is you're actually seeing the breadth of the market finally turning higher. That is a very big deal. Again, I'll stress a very big deal that is happening. And Dave, if you go back even further, I'm not sure how far you can go back on this chart, but if you look at other prior major downturns in this market, you'll see that some of these breadth measures have gotten to be extreme levels with the most recent sell-off in June. And when we've gotten to these levels previously in the past, the market has experienced what we define as a breadth thrust off of the lows. And that is a very powerful move. You had seen that back, obviously, in March of 2000. You had seen it back in 2008, 2009 during the great financial crisis. You had seen that in 2011. You'd seen that in 2016, 2018, and those various periods. So what I'm trying to say simplistically is the market has already discounted a lot of bad news, and it is already sort of reflected and baked into the market. I'm not sure we're going to get anything incrementally more negative coming out of Jackson Hole. Things are already pretty hawkish. We've already seen the Fed raise rates multiple times. And in terms of a recession, most likely we're probably already in one. If you look at the standard definition of 2 quarters of negative GDP growth, Dave. So I guess what I want to say to everybody is follow the charts. And Ralph is right. You want to just follow price. Price is going to tell us what we need to know. And at the end of the day, price is fact. And that's what we need to follow is price.
When you're, it's a great, I appreciate you talking through all those components. You touched on a number of things there, Craig, for sure. When you're looking forward between now and year end, I know you have a year end S&P price target, which I'd love to hear. And then how are you thinking about how we get from this point to that point?
Sure. And let me hit one more thing on breadth too, Dave, that I just want to mention is when we've had these prior washout periods in terms of market breadth, looking back in our work to the 1970s, only one time when we had seen a breadth thrust coming off of extremely washed out levels have we had a negative return, and that was during the great financial crisis. Nobody is looking for that sort of negative return in this environment. And Dave, coming off of all those prior washout levels in terms of market breadth, the S&P was higher on average 18% coming off of those breadth thrust levels, and a positive rate was 95% at the time. So how do I get to my year-end objective of 47.75? This is going to be the breadth thrust carrying us up to those levels before the rocket ship sort of has to sort of lose the momentum and sort of come back down to earth. And that's where I think we're at this point in time, and how we're going to get to the 47.75. And I got to tell you, the negativity, just look at the commitment of traders report out there. They're negative at this point in time. This would be extremely painful if this market went another 15% higher from where we are right now, because nobody's positioned for it. And I got to tell you, the old adage about the markets are going to do the most painful thing to the largest number of people possible. And that right now would be to go higher, not lower. And that's exactly why I think we are going to go higher in this market. And I think all the technicals sort of align to suggest that this breadth thrust is not just a bear market relief rally, but it is actually something far stronger.
Craig, that is a very encouraging take on this market environment. I really appreciate you talking it through us. And I have to agree. I mean, I totally get the argument of the strength off the lows. It's been impressive, and it's certainly been different than what we've seen previously in 2022 so far. Craig, it's a pleasure to see you. Thanks as always for coming on the show. I really appreciate it. Be safe, Dave, there in Minneapolis. All right.
Thank you, Dave.
That's Craig Johnson. Craig's the chief technical strategist at Piper Sandler in Minneapolis. Does a great job. I mean, if you hear it, a very constructive view on how things have happened. What I love about what Craig says, a number of different things. Number one, focus on the evidence. If there's one takeaway I had from what Craig just said, it was to focus on the evidence, which I think we could all stand to be reminded of that often. The other thing was recognizing the value in market history. If you looked, when he's sharing some of those stats about what the market has tended to do after the breadth moves that we've seen, it reminds me that if you're super bared up at this moment, this would be an unusual outcome given all the market history that we can review, right? In bull cycles, bear cycles, and everything in between, we can see what's tended to happen after some of these characteristics have played out. So interesting to see a pretty constructive take there with Craig, and essentially retesting the all-time high there going into year end. Thanks so much there to Craig Johnson at Piper Sandler. Let's continue on our show looking at the final bar mailbag. As a reminder, the mailbag is always open at the final bar at StockCharts.com. And let's get to question number one. Dave, is it possible that the DXY, which is the dollar index, goes down and stock market goes down? So basically both the dollar and the stock market go down together, because on the chart, they seem to be inversely related. And this was the chart that you actually, this is a chart that I created based on your questions. I remember putting this together at some point. And I think this is the chart that I might have put together. You might have sent it too. So I apologize if that's the case. On StockCharts, by the way, the ticker is $USD for the US dollar index. If you're looking for more short-term information, because we get that actually at the end of day, UUP is a bullish dollar ETF, which will get you a good read on changes in the dollar minute to minute during the course of the trading day. But what you were asking is it possible that both the dollar and the S&P go down? And the answer is absolutely. I'm looking back about 20 years here. We're going back to 2002. And if you just glance through this history, looking at the S&P in the top panel, the dollar on the second panel, and then the correlation of the dollar to the S&P, you can see that there are times when they're both very positively correlated. 2014 is a good example of that, where the S&P is going higher on a much stronger dollar. You can see that there are, just like that, there are other times when then the relationship completely changes. 2017, the market's going higher on a much weaker dollar. So Robert Prechter famously has shared a lot of great stats on this issue, not just with the dollar and the S&P, but on making simplistic relationships between two variables. What you have to remember is if it's a simple mechanism, you have two variables or three variables, you can very easily say when X does this, Y does that, and be pretty confident that that's going to actually play out. The financial markets are a very complex mechanism with a lot of different catalysts, a lot of different things changing values on many different timeframes. And as a result, relationships will be the same until they're not. John Murphy, who literally wrote the book on intermarket analysis, really addresses that in his books, where he talks about the sort of traditional, the classic relationship, but admitting and acknowledging that those relationships evolve, and you have to actually recognize how that changes. If you look at what's happened most recently, 2021, particularly the latter half of the year, the S&P was going higher and the dollar was strengthening. That changed very much as the stronger dollar started to be what we call the wrecking ball, and the dollar strengthening and pretty much everything else was going down. Stocks, bonds, commodities at times, all kind of rotating lower. That is one of the issues I see with the dollar really spiking to the upside and moving higher, because that inverse relationship in 2022, that most likely would suggest that risk assets come off a little bit. But again, that relationship certainly can change, as this chart, I think, aptly demonstrates. Question number 2. How come the Food and Retailer and Wholesalers Index, which is DJUSFD, I'll bring that up as I'm reading this, that index is up almost 24% in the last 3 months, with only one company being over that number. One of the stocks, a mid-cap stock, SFM, was up 36%. So how can the index be up 24% when a lot of the stocks that comprise those indexes are not up that much? So this gets into a really complex and confusing part of the financial industry, which I will try to summarize in about a minute, if that. Coming up with sector and industry classifications is an exercise in imprecision, if that's a word. It is incredibly imprecise, super difficult, and I'll tell you why. Take any stock, Disney, Apple, Amazon, a grocery store. Some of them are very easy. Like a grocery store makes sense in consumer staples because that's pretty much what you're buying at a grocery store. Things you need, like toilet paper and beverages and food. There are other things that make sense that don't make sense in a particular industry. Disney is a classic example. Solar stocks. Are they part of energy? Are they part of technology? Amazon could be in any of 4 or 5 different sectors because they have streaming service. They're a media company, right? So trying to find ways to classify stocks is very, very difficult. We do our best by using the S&P economic sectors, which are pretty industry standard. Then we use the Dow industry groups, which we have very liberally adjusted based on where we think stocks should be. And that's part of the joy of my role as chief market strategist, working with our data team, is thinking about where things should be bucketed. So for example, we bucket the solar stocks and hydrogen names with technology instead of energy because they're much better mapped to newer technology than they do to an oil and gas company. So what happens is the Dow industry groups are price weighted and can have a certain set of returns because of how Dow Jones defines that group and calculates the indexes. When you look at our industry summary tab, we could be looking at some subtly different names because of where we actually bucket different stocks and which stocks they are including. We don't have transparency into how they're calculating some of those indexes. We just do our best to show you the names that probably represent those indexes. And that's why the returns can be a little different, often when you may not expect it. Final question, then we have to wrap. XLP has been underperforming the S&P since July. Is the current pattern of the XLP a head and shoulders in the making, like a right shoulder? And this was the chart you sent. You sent a permalink, which is the link below the chart. Thanks for that, because I could see exactly what you were talking about. Is this a head and shoulders forming? So I think what you're identifying is this head here, the lower shoulder to the right, the lower shoulder to the left. Very, very interesting. And I would say the MACD or the PPO certainly seeming to line up with that because you have 1, 2, and now 3 potentially looking very, very similar. So is it indicating a bit of a topping pattern? Arguably, absolutely, right? If you get that completion of the sell signal, it's just not quite there, but it's really, really, really close. To really tell if that's a head and shoulders, though, what I would immediately do is bring in way more data. So I'm going to look at like 4 years. Now you can see that this head and shoulders is here. That's the last year you were showing me, and I can see how it's evolved from this trend. So is that a head and shoulders top? Here's the problem, and the reason why I can say not, maybe, but probably not. And here's the thing. A head and shoulders pattern is all about the neckline, and the neckline is the interim lows between the head and the 2 shoulders. So there's the low, there's the other low, and I basically connect a trend line. So for this to be textbook head and shoulders pattern, the price would have to get all the way down to 65 to even break that neckline. It's all about the neckline. And head and shoulders patterns usually don't have a descending neckline. It would usually have a flat to ascending neckline. So is it a classic head and shoulders pattern? No. What would it need to be a head and shoulders pattern? You'd actually have to break all the way to the neckline. And by that time, you're all the way down to 65. I feel like at that point, we won't even care that it's a head and shoulders. We'll be thinking about other things and other forms of analysis. But I would be watching that trend line, certainly, if we would drop to that point. So that's the way to think about head and shoulders. Bring in a little more data and make sure you focus on the neckline. And that is the most important takeaway there. That's it for the mailbag. Thanks so much for those great questions. Keep them coming. We need to wrap the show and go to the 3 and 3. Let's highlight 3 charts in a couple minutes that tell the story of this market environment. Chart number 1 is the dollar index, which is $USD on the StockCharts platform. Down a little bit today, but coming off a new closing high for the year yesterday on Monday's session. We've highlighted this chart many times. The market moved higher and growth outperformed value in 2021. However, in 2022, the conditions very much have changed. Stronger dollar has lined up with value outperforming, with growth underperforming, and it's really lined up with the bear market phase. The market has rallied June, July into August, partly because I think rates have come off and the dollar has come off. Watch out because rates have moved higher now in the last couple of weeks and the dollar moving higher as well. So far in 2022, that's been a bad sign for growth and a bad sign, broadly speaking, for risk assets. Chart number 2 is the commodity index. Last couple of days, you've had the market flat to down, although energy and even materials have done very well. Part of that is the fact that commodities are starting to re-exert to the upside. Some energy stocks are actually making new highs. I'll share with you one of those here in a few moments as my third chart in the 3 and 3. We've talked about how the XLE pulled back to moving average support, now making a new swing high. We talked about how some previous leadership names like DVN, FANG, and others kind of rotating higher. Occidental was one of the top 10 S&P names today, for example. Wanted to highlight today that the broader commodity complex starting to rotate higher as well. Part of that pattern in July and August has been commodities coming off, rates coming down, the dollar coming down. You're now starting to see all 3 of those rotate back to look more like what they did in the first half of 2022. Now, while I can't guarantee the bear market just resumes and we make new lows, it does tell me that this exciting move we've had in July and August is starting to change, and watch for higher commodity prices and think about how that might affect some of the stocks in your portfolio. Finally, PBR, which is a Brazilian oil company called Petrobras, one of the largest companies listed in Brazil, overbought right now, making a new closing high. This is a reminder that in any environment, some stock somewhere is breaking out to new highs. Folks, that's our show for today. I want to thank Craig Johnson from Piper Sandler joining us from Minneapolis. Great, constructive take, bullish take on the market environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.